Hello, my name is Richard Claywell, and this is Litigation Speaks. Today I want to talk about the discounted cash flow and the capitalization of earnings and how the change in net working capital impacts both of those methodologies. The capitalization of cash flow is used when the earnings and or the cash flows are stabilized. That means they're going to be fairly consistent from year to year to year. If they are not consistent, then the capitalization of earnings or capitalization of cash flows should not be used. It should only be used if those are stabilized. The second methodology is the discounted cash flow. The discounted cash flow is designed for valuing companies where the earnings or cash flows are not stabilized and we're better able to handle problems that the capitalization of cash flows cannot handle. So we have two primary methodologies under the income approach. When we do both of these methodologies, what we want to do is to normalize the financial statements. Normalizing means we want to go out and we want to locate and adjust for anomalies that are there, remove the anomalies so we have a better stabilized cash flow to project into the future. Part of that process is looking at the changes in the net working capital. Net working capital really has two definitions, and it's taught two ways. The first definition I want to talk about is what I would call the accounting or the CPA definition. When we go to school as a potential CPA or get an accounting degree, net working capital is defined as all of the current assets less all the current liabilities. The difference between those two is the working capital. The problem we have with that is that's an accounting term. It is not a valuation term. From a valuation standpoint, what we take a look at are the total assets minus the cash minus the liabilities. That's the definition of working capital from a business valuation standpoint. It makes a little bit of a difference. Where I see this is when we get a report in, and primarily is for experts that don't have a whole lot of experience in what they're doing with this, and they don't quite understand the distinction between the two, and almost every one of them are CPAs. I took a report that I had worked on previously. I looked at what the changes in working capital would be and the value of the company. The value of the company was about $1.5 million in value. I took and that included the adjustment for the net change in working capital. I removed the adjustment for the change in working capital to see what that would do to the value. It actually reduced the value, and it reduced the value by 37%. So this is another easy way for someone to manipulate the value of a company. Do I want a higher value? Do I want a lower value? And adjusting for that or not adjusting for the change in working capital will probably meet your needs if that's what you want to do. One of the things I would suggest that an attorney do is look at a report and look for the change in working capital. You're probably not going to see this because the experts don't want to show you what they did. But look for that. If you don't have it in the report, ask for it in the work paper file. See if they actually made an adjustment to reduce the net working capital by the cash. So now the question becomes, why do we want to remove the cash? What we're trying to do under both of these methodologies is to determine the value of the cash. The change in working capital deals with the cash flow that we have. We're trying to determine the risk of receiving the cash flows, whether we capitalize or we do a discounted cash flow. So what we want to do is, if you're using discounted cash flow, is to get the present value of those cash flows, because there's risk associated with that. Now, if you think about this, on your financial statements, what you have in your bank account, you've already got cash. How risky is the cash you've already received? Zero risk. There is no risk associated with that at all. So you have to remove that when you do the analysis. If not, you're going to include cash in your risk assessment that is incorrect. So those are some things to look for when you do a capitalization of cash flows or the discounted cash flow methodology. If you have any questions on how this works or any questions on the previous presentations that we've given, feel free to either give me a call or send me an email. If you have any comments on this, if you'd like to post them to LinkedIn or any other place, feel free to do that. One of the things I would like to do is we're doing these presentations based upon what I think you would like to know. I would appreciate it if you would tell me what you would like to know, because then I can do a presentation that explains in some detail the issues related to your specific topics. Thank you for being with me today. We'll see you in a couple of weeks. Thank you.